I'm Sumaira Abdi. On the show today, did you know that many of the most actively managed funds in India are some of the cheapest in the world? In some cases, in fact, they are cheaper even than the index fund. So what does it mean for investors? Should you rush to these funds? Should you be wary of their regular plans? What do you do? Firoz Aziz, Deputy CEO of Anand Rathi Wealth, and Mohit Gang, CEO and co-founder of Moneyfront, join in. Gentlemen, good afternoon to both of you. Mohit, my first question to you is that, everybody knows, we do realize that there is a difference between the expenses of a regular plan and the direct plan, and the difference being the brokerage which is paid, right? Or the distribution commission that is paid. But if you look at the trend, especially when it comes to new fund offers, NFOs, this difference or this window seems to be very, very huge. Can you explain to us why this is increasingly becoming a trend? And what does it mean? I wanted to check why this big difference between the direct and regular plans, especially where NFOs are concerned.
Okay, so what happens technically is when a fund has typically a new NFO, when it goes to the market, it predetermines what kind of collection it will have. So let's say an XYZ scheme goes to the market, they can assume that they will collect roughly around 5,000 crores or 10,000 crores. We have recently seen an NFO collect almost 10,000 crores, which is an epic record in the market, right? So when you assume that, you also base your TER accordingly, because of the SEBI slabs define your TER has to be as per your AUM which you collect. So let's say if you assume that you will collect 5,000 odd crores, you put your distributable TER at around 1.5 to 1.65, 1.75 odd percent in an equity fund. And then you first determine what kind of a commission you want to pay to your distributors or the channel partners. Now, this commission could be because you have to incentivize an IPO sale. This commission could be fairly high in the first year, right? So this could be, let's say, around 1.25 odd percent. And if the overall expense is 1.5, the remaining 25 bips is something which the AMC keeps for its own managerial expenses, and which then becomes the expense ratio of the direct plan. Right. So this is how a direct plan expense ratio is determined. Whatever is the overall management expenses of the AMC, that technically becomes the direct plan expense ratio, right? So what is happening is, to incentivize the distribution channel, initially the margins of distributors have been kept fairly high in the NFO period, and that typically means that the direct plan NAV has been the direct plan expense ratios has been very, very low for all the new offers which are coming into the market. And that is one of the key reasons why this is happening.
Okay, but I don't know, somehow that I'm sure that's how the math worked, but to an investor it just sounds weird, because to me it seems as if the commissions are kept high to aggressively push out the NFOs. Firoz, is that really the case? I mean, would it, and like Mohit said, that the commissions are kept high in the first year, so expenses are kept low in the first year. Does it mean that therefore, if you're buying into a regular plan, you expect that commissions will go up? How much? And what does the difference in this commission mean over, say, a 10-year period, right? Which is what most investors, I'm assuming, would have for an NFO.
Yes, Sumaira, I think like Mohit said, there is sometimes a surprise in terms of what amount you end up collecting. And since the TERs are completely dependent on the AUM which you have in a specific scheme, so there could be some degree of a plan going out of order for asset management companies as their collection goes up. So having said which, like you said, Sumaira, in long periods of time, this differential commission between regular and direct is substantive. Especially in these cases of NFOs where the difference is as much as 1.5%. If you take ICICI FlexiCap, which has on the regular an expense of close to 1.7, 1.75, but in direct has an expense of only 0.18. If a person invested a lakh, assuming a 12% return, a lakh becomes a 3,10,000 in regular. At the same return, plus the lower cost benefit, gets you to 3,56,000, which implies that on every 1 lakh, you have 46,000 more in 10 years. So this steep differential between regular and direct as an illustration.
Okay, so basically, like Firoz said in the example that he's spoken about, 46,000 is the difference over a 10-year period. Mohit, is this the case only for NFOs or for a lot of the existing schemes as well?
Look, so difference between direct and regular will typically depend on what kind of a strategy a particular fund house wants to adopt, right? So if you really want to incentivize the distribution channel and if you want to push your product, so I'll give you both examples, both sides. So let's say if you have the matured schemes, let's say a Kotak Flexi Cap, which is almost like a 35,000 odd crore scheme, or let's say a Mirai Large Cap, which according to the fund house has attained a critical mass and is a fairly large scheme, right? So if you see the direct plan expense ratios in these schemes, it's very, very low. In fact, it's like in Kotak, if I'm not wrong, it must be roughly around 60, 65 odd bips. And Mirai, it should be around 55, 54 odd bips, right? So which is very low for an actively managed fund with direct plans, right? But if you see the regular plans of these schemes, a Mirai will have a very high expense ratio on the regular plan, but Kotak, the regular plan expense ratio is very low, which means the distributor commission in Kotak FlexiCap is less, typically implying that the fund house is actually not wanting to push the product so much because the AUM is fairly large out there. Maybe that could be one of the reasons, or it could be other reasons also, or maybe they are trying and incentivizing the distribution on some other schemes of their fund house, which could also be the case, right? But in typical case of Mirai, you could see that the regular plan expense is fairly high. So which also implies that the fund house is equally keen on pushing the product across the distribution channel, right? So you have both examples. And then there are schemes where you will find that the direct and regular expense ratios are the difference is very little. Let's say an ICICI focused blue chip fund. The direct expense is also above 1%, roughly in the range of 1.1, and the regular expense will be 1.6. So difference is hardly 50 bips out there. That implies that the fund house is actually retaining a lot of amount as their own profitability out there because they've kept the management expense fairly high at around 1.1, which means they want to be profitable in that scheme now. And that's the strategy. So all fund houses adopt different strategies for different schemes with different AUMs at different junctures of the life cycle of a fund, Sumera. So there's no one size fit all formula out here.
Yeah, and that seems pretty surprising because I would have thought that you'd sort of decided for every scheme by the same yardstick. But Firoz, what does this mean now? And I'm not at all suggesting that investors do away with advisors, because advisors do add value, right? Which is why SEBI has allowed for regular plans to be in existence. So how does a person as an investor decide that I mean, an investor has no way of knowing, right, how the AMC, like Mohit said, will decide the fate of each scheme, especially with respect to expenses. And by no means are expenses the only way to even decide which fund you want to invest in. But when you have this short list, how do you decide when do I go with an advisor? When do I go with the regular plan? I mean, what difference is too big to miss?
Sumira, I think firstly, research throws up that the cheapest ones were not the best ones. Now, for example, if you list down the funds which have the least expense in direct and have been in existence for the last 3 years, the top cheapest ones actually have generated not significant apart from one or two of them. So point one I'm making is an investor should be clear, not always lower cost can result in a larger value gain. So cost is an important criteria. But assuming that lower cost will create value may not be true. At least with the cheapest 5 funds, I don't see the best alphas having come through. That's one. And the most important thing which you said, Sumera, how do I decide as an investor, should I invest through a distributor or go direct? To my mind, if you have a distributor or an advisor who can handhold you and help you control your emotions during tough times, then it is worth paying that 0.7, 0.8, 0.9%, which is the normal differential between regular and direct in most schemes. So that's one. For example, like in Anand Rathi, last year, when the industry had a negative outflow, our clients had an inflow and got the complete rally of a 70-80%, which was the last financial year's equity movement. So the point I'm making is, if the distributor is giving you a lot of peripheral services, be it hand-holding you, helping you make decisions on asset allocation, helping you decide the risk of it and all that, then he's doing holistic wealth management for you. go with all schemes in regular. If your product selection is on the basis of a show, so much content is there, Sumera, in all your shows where you're giving great advice. And if that's how you're choosing a scheme, then definitely go direct and save the cost because you're getting information for free on platforms like the electronic medium. So that's the second part. The third, I personally think India being the cheapest because of SEBI's regulation, which came into effect a while back, cheapest active managed funds in the top 5-6 economies is a great news for investors, irrespective.
No, Firoz, you're absolutely right. We're going to talk about that global example when you return after this quick break. And also on the other side, we'll talk about how does it happen that some of the most actively managed funds are actually cheaper than even index funds. How do you explain that? All of that is lined up next. Stay tuned. Hi, welcome back. You're with MF Corner. Our two experts, Firoz Aziz and Mohit Gang, are with us, and we've been talking about how is it that India has some of the cheapest actively managed funds in the world, and what does it mean for investors. Firoz, in some case, some of these active schemes end up even being cheaper than index funds. I mean, like we were talking earlier, AMCs can have different strategies about, where they want to lower expenses, where they want to push the scheme through the distribution channels, etc. But surely they have some expenses, right? So how can it end up being cheaper than index funds, and what is the global average?
I think, Sumera, the reason why an actively managed fund in India can incidentally also get cheaper than an index fund is because of the regulation of SEBI on how this difference is arrived at. Whatever you pay as distribution commission should be reduced from regular, and that's the maximum you can charge on direct. So the more the asset management company pays the distribution commission, the larger this gap widens, and the direct keeps coming lower and lower. So that's happened. If I look at some index funds which have a 0.15% expense, and there is another Birla Sun Life multi-cap fund which is cheaper than 0.15%. That's like the cheapest in the world, I'm very sure. And that's owing to this regulation which came a couple of years back to arrive at what direct cost could there be charged by an asset management company. Second, if you look at
so basically,
matured,
yeah.
Sorry, Sumera. If you look at the top matured markets like USA, you're speaking of the active managed fund. The cheapest one is at 0.3. So you're still half of that as in India, in spite of US being probably having 100 years of more capital market history.
That's right, and SEBI has actually given out a whole formula by which this TER can be calculated, and that is a maximum which can be charged. Short of that, like Firoz says, you decide on the distribution commission and then you adjust the direct plan accordingly. Mohit, how much cheaper can funds get in India, or rather, what is the upside to increase the distribution commission, if I can say that now? And how does, in your opinion, an investor decide, between going direct or going regular?
Okay, so Sumera, how much can a fund go cheaper? Honestly, I think it's a race to the bottoms. And worldwide, we have seen, I think US, this philosophy was first promoted by Vanguard. Jack Bogle was the biggest philosopher of low-cost index investing. Then it went viral with iShares, Schwab's, everyone picking it up. And finally, Fidelity did the unthinkable. Around 2018, I think they came out with a fund with an expense ratio which was promoted as a zero expense ratio fund, which honestly the expense ratio was out there 1.5 bips. So 0.015%, which was an index fund actually. So globally, there are examples where this race has actually gone to almost zero or nearing zero. In India, we have just seen an example of Navi mutual fund coming out and taking the cost of an index fund down to 6 bips for the direct plan of an index fund, right? But as Firoz was rightly saying, there are actively managed funds which are at as low cost at around 14 bips, 16 bips or something like that, which is unthinkable, honestly. And that actually is hitting the profitability of fund houses. To my mind, I think 15 bips is something which is a bare minimum expense which a fund house incurs in terms of managerial expertise, expenses, overheads, other things, right? And below which I think it actually hurts their profitability. So I'm not sure whether these expense ratios are sustainable on the active side, but yes, on the passive side, I think it's a clear race to the bottoms. To answer your second part, how should an investor decide? Look, honestly, between direct and regular, there's very little to pick unless you don't have proper handholding. Then it's a different case, but otherwise the ball is clearly in favor of direct plans, right? If you find advisors, there are fee only advisors, there are direct plan platforms who will provide you proper advice, asset allocation and everything, as Firoz was mentioning, and offer you direct plans, right? So that's the way to go typically in India as well. On the regular side, yes, the market is bigger, but it is kind of hovering towards the direct side. And if you see, the passive share is also been increasing year on year. So the trends are very clear globally and in India. However, the Indian market being so widespread, I think it will take some time for investors. Both the choices are there. Wherever you find an advisor's comfort or your own comfort in terms of the person who's advising you and guiding you, go that way.
Absolutely, and Mohit, you've put it in absolutely the right words when you said it looks like a race to the bottom. Firoz, is that how you see it? That lowering the expense ratios continuously is going to dent margins, profitability, and will it end up being detrimental to both AMCs and investors?
Sumera, I personally think that if somebody reduces cost beyond a certain point, creating value, the responsibility of creating value keeps diminishing. So my firm belief is, if there is a tender, you would never give the order to the cheapest source. So I personally believe value is inversely correlated to cost. If I, as an advisor, don't make 0.8%, 1% a year, I would not want to do the maximum value creation. So that's my firm belief. Second, of course, margin pressures are already there, and I don't see further compression of margin for the distributor fraternity or the asset management company fraternity. The cheapest offers which you get over a period of time, a client will realize those are not the best value creators. That's our firm belief. Coming to expense ratios, I personally think Indian market will go through some degree of innovation, which the global market has gone through. But there have also been funds which are proposing negative expense ratio on the basis of innovation of the stock lending and trying to make money there instead of charging the client. So I think innovation will create better benefit for the client, but I think margins are at the lowest. I see the trend, like Mohit mentioned. But there will be people who will create value to justify that 0.5 to 0.8% they earn. And I'm sure they'll be successful if they put in cost and energy to create the value for people.
All right, Mohit, Feroz, thank you very much for joining in. So the word coming in from our experts is that yes, there is this trend that on the direct side at least expenses are becoming very, very low and in turn unsustainable, primarily because to my mind it appears in this race to mop up the assets to retain that top spot in the rankings. But advisors do add value, and if you so choose to go with an advisor, like Feroz said, they will be doing some sort of value addition to earn that 0.5, 0.8% extra. However, if you are an investor savvy enough, do consider choosing the direct route. You will see that difference over a longer period. With that, we're out of time on MF Corner. Thanks very much for watching. Stay tuned.